There we are.
All right. Hello.
Okay. Hello, everybody. My name is Peter Kote, and Eugene, thank you so much for doing this. And you're right. Stepping into Don's shoes, Don has big shoes. um, Marty, would you like to come on board? Howdy.
Good morning.
Hey, you're going to be our first guest presenter and for our 6-week journey. So, as one of the presenters, one of the first things we do is go through your Ask First form. And we're going to go into it a little bit more in detail than other presenters, only because this is the very first, you're the very first one. Lucky you. Why don't you go ahead and put your Ask First form on the screen? Now, the reason why we use the Ask First form is because when I was at Long Beach State University and asked people, professors and staff, who did you use as far as an advisor? One of the first comments that came back to me was, he is a really nice person. And you want your financial advisor to be nice, but you want them to be a little bit more than nice. So when I asked individuals, do you know their education? Do you know how much they charge? Do you blah, blah, blah? They knew actually very little about them. So we encourage you, if you're going to speak with somebody about money, make sure they complete the Ask First form. First of all, was anything offensive about this form, Marty?
No,
No. And how long did it take you to complete it?
less than 10 minutes.
Yeah. So pretty easy to complete, shouldn't be a problem. And we recommend highly, if you do have an advisor, you don't know this information about them, make it a class project. Send them the Ask First form and ask them to complete it and tell them the teacher told you to do so. So if you're reluctant. Okay, you have a bachelor's degree, which is great. What is it in? And where did you get it?
I studied accounting and finance as a double major, and I graduated from the University of Dayton.
Oh, Midwesterner. How long did you live in the Midwest?
24 years.
24 years. So, which is, hey, if you're going to be in the financial services industry, it's a great background to have. So, your credential is, you said you're a CPA. Do you practice as a CPA?
My firm does a lot of tax work, but we do not prepare income tax returns.
So being a CPA gives you that background to communicate with other CPAs and you keep that license?
Correct.
Okay. And then you have what's called a PFS. What does that mean?
The PFS is a credential that's available only to CPAs. CPAs can do a variety of different services, from working at big companies to more along the lines of what we do, which is helping people with personal finances. So it's just meant to designate what type of work we're doing within the CPA field.
Okay. And you have to have a CPA to do it, to be a PFS. One of the reasons why we're kind of going through what these initials mean is that there's over about 125 to 150 different designations in the financial services industry. And one of them being the CFP. What is a CFP?
Certified Financial Planner is what the designation stands for. And it requires a lot of coursework across different disciplines related to personal finances.
So would you say the CFP is probably one of the most recognized designations in the financial services industry?
Yes, definitely.
Yeah. And today, to get a CFP, you have to pass, I think, like 6 to 7 courses. You have to take an all-day exam. The exam pass rate is about 60 to 65%. It's not a give me designation today. And many of the designations that you see in the financial services industry, you basically buy them. And so they don't have a lot of meaning, but people usually don't try to figure out what a person did in order to earn that designation. Let's talk a little bit. What I think is the most important credential for you is the 21 years of experience in investments, financial planning, including estate and income tax planning. Talk a little bit about your 21 years.
Sure. So my first job out of college was working at Deloitte, where I prepared income tax returns. I worked about 80 hours a week for a couple of years, and I learned a ton, but I realized I didn't like working 80 hours a week, and I didn't really like tax deadlines, and was more interested in financial planning. And so I made a move over to a boutique wealth management firm in Ohio, where I worked for a few years. And then I realized I didn't want to live in Ohio. And so I moved to Orange County in 2007 and worked for another boutique wealth management firm for a few years here in Newport Beach. And then spent about a year and a half at Northern Trust, which was a big publicly traded company with tens of thousands of employees. I learned a lot there, but I didn't like working at big companies. And so that's when I decided to start my firm, Merrick Wealth, in 2012 with my business partner, Patrick Chu. And we're located in Irvine, close to John Wayne Airport. We've been in business for about 12 years now. We work with about 80 households, and there's 4 of us at my firm that service the 80 families that we work with.
What do you do for a typical one of your clients?
Yeah, so we provide a variety of services, but we manage their investments by using Charles Schwab as the third-party custodian. So that's one of the services we provide. In addition to that, we provide income tax planning services where we review their income tax returns and project income taxes and strategy moving forward. We also look at insurance policies or what insurance policies they should have. We'll look at estate planning documents, and we'll also just work with other professionals that they have on board, whether that be a CPA or insurance agents, attorneys.
Okay. And then relevant licenses. You're a CPA, and that is through Illinois, of Chicago. What is that? From Ohio. There you go.
Ohio.
Ohio.
Yeah.
And you maintain that license.
Yeah, I maintain that license from the Accountancy Board of Ohio.
Okay. And so why is it important to know what board or how someone in the field maintains their license?
It's a great way to research whether there's been any reporting related to that professional and whether there's been any problems that have been experienced. So you can go to the Accountancy Board of Ohio and find out whether my license is in good standing or not.
Yeah. Well, I see here you're not licensed in the insurance area, or that you're not licensed in the securities area. So if you can't sell me insurance and you can't sell me a mutual fund or an investment, so what do you do?
Sure. So I'll recommend different investments and we can help you trade on those, but we're not compensated, through an insurance company or a mutual fund company. All of our compensation comes directly from our clients. And so we really give advice and help clients implement any of the recommendations they wish to implement.
Okay. And then talk a little bit about you use Schwab as your custodian. Why is that important to know?
Yeah, I think it's really critical to have an independent custodian. So my firm is Merrick Wealth, right? I'm employed and compensated by my firm, but um, Charles Schwab is the holder of all the securities. We're given a limited power of attorney by our clients to access their Schwab accounts for really three reasons. One reason is to trade on their behalf. The second reason is to send money to their bank account, or if they want a check mailed to their home, we could do that. And then the third reason is to deduct our agreed upon fees from their accounts. We can't do anything else besides those three things on those accounts. And so that's really important.
So
Because,
what is the difference between you and our friend Madoff?
yeah, Bernie Madoff was his own custodian, right? So clients were receiving statements from Madoff's company that we later found out were fabricated, right? And so we can't do that, right? Our clients can go onto the Schwab website, view their own statements, their transaction history. And if they decide they don't want to work with our firm, they can contact Schwab and say, please remove Merrick Wealth from my accounts.
And how does Schwab make money from you?
Um, Schwab makes money a few different ways, but it tends to be pretty small dollars. Trading, they have ticket charges on trades, so that's one way. They can make money on money market funds and cash that's held in client accounts. And then the last way is if Schwab investment products like a Schwab mutual fund or a Schwab ETF are bought in an account, they they stand to earn revenue there as well.
If I if I want to fire you, Marty, I hired you a month ago, and I've come to figure out I don't really like you. You're not as nice of a guy as I thought you were. How do I fire you?
Yeah, you can call me and we'll delink from your Schwab accounts, or you can just call Schwab if you decide you don't like talking to me. You can call Schwab directly and have them remove us
Yeah.
from accounts.
Yeah.
Yeah.
It's important to know how you fire somebody or how you sell a particular investment before you invest in the person or in the product. I notice on the relevant licenses that you have a Series 65. What is that and what is FINRA?
Yeah. So FINRA is the regulatory body that oversees all the series. The Series 65 in this case legally permits me to give investment advice.
It doesn't give you permission to sell investment products. Is that correct?
That's correct. That would be a Series 7, where you're permitted to sell and earn fees from the sale of investment.
So Series 65 is more or less a registration.
Yes, correct.
Okay. The financial services industry is all about full disclosure. And so, how do you provide full disclosure to your client? Can they look you up on FINRA?
Yes, FINRA has a website. You can look me up there. You can look up our ADV. That's the name of the form that requires us to provide information about our business practices, our background, and how we charge clients for the services that we provide.
So we're going to get more into this later in the workshop program, but you have to understand that the overall agency that controls the investment world is the Securities and Exchange Commission, SEC. They give it to a self-regulatory organization called FINRA, and FINRA does the full disclosure for all advisors. And so you can Google broker check, and then you will get the FINRA website. You can plug in Marty's name or the name of his firm. And since he doesn't have a Series 7, you will be guided over to the Securities and Exchange Commission website, and you'll get full disclosure as far as Marty's background, how he charges, who he employs, et cetera, et cetera. So it's really important to check out whomever you're going to talk about money. You need to check with FINRA. We check with FINRA for every presenter that comes on the program or gives us advice at any particular time. And if you've done something bad, does it show up on FINRA?
Well, if it's been reported, yeah, it'll show up. It's called a disclosure, where
Yeah.
there's been a complaint from a client or someone else I've done business with that's complained.
Yeah. Yeah. I just learned the other day, but Oppenheimer is a brokerage firm, and 1 out of 5 quote unquote advisors have a disclosure. So you do not want your advisor to have disclosures, and you need to check them out to make sure that they don't. Because again, it's everything is based on full disclosure. If we tell you everything there is to know about an investment or about an advisor, then you as a reasonable, intelligent individual can figure out what you want to do. Well, I don't know if you've read a prospectus lately, but it's pretty hard to read. Is the ADV form easy to read, or is it understandable as far as you know?
It's easier to read than a prospectus, in my opinion, but I wouldn't call it easy or light reading.
Yeah. How many pages is your ADV form?
I think ours is between 30 and 40 pages now.
Yeah. It keeps on growing. Yeah. Okay. The next, you do not practice law, but in your financial planning, you look at people's estate plans, correct?
Correct.
Yeah. So you go over it with them, discuss with their attorney if it needs to be, who's the successor trustee, what kind of tax ramifications are involved with a trust. You basically go through all those things, but you do not practice law.
Correct.
Okay. Next one, business relationship. What does that mean, being a fiduciary?
Yeah, as a fiduciary, we put our clients' best interests first and foremost, ahead of our own interests. And so
doesn't everybody put their clients? I mean, what kind of business would you run if you didn't put your clients' interests first?
Yeah, surprisingly, there's more financial advisors that work under a suitability standard.
And what does that mean?
A fiduciary standard. The suitability standard means that it just needs to be suitable. It doesn't need to be necessarily the best for the client. And it's a lower level standard than the fiduciary standard.
So if you recommend, for example, a mutual fund that pays a commission versus a Vanguard, you could be held liable for giving that kind of advice?
As a fiduciary, yes. If you're working under a suitability standard, no.
Okay. So it's really important to see what level of standard your advisor is. By the way, is there a rule as to what you can call yourself?
No.
You can call what do you call yourself?
Wealth advisor, co-founder.
Yeah.
Those are the two things you'll find.
Yeah. But you can call yourself literally whatever you want.
Yeah, correct. Yeah, as long as it's not something that's licensed. Like you couldn't make up being a CPA, right?
Yeah.
But you could call yourself a financial advisor, a wealth advisor, a financial consultant.
Exactly. Put anything on your business card. That's why you need to check things out. How do you charge your clients? And how are you compensated?
Yeah, so our clients are charged a fee as a percentage of assets that we manage. The fee starts at 1% per year, and then it works on a graduated schedule. So As clients add more assets to the accounts that we manage, or as the accounts grow, the fees can hit breakpoints and it becomes less expensive. But that's how we charge our clients.
Okay, so that particular model in the industry is called assets under management,
Correct.
AUM. Uh, do you work on an hourly basis?
Occasionally, it's rare, but I would say there's maybe one or two engagements per year. We'll charge someone hourly. Our hourly rates vary depending on the professional doing the work. It can be as low as $175 per hour up to $475 per hour.
Okay. And then you mentioned your staff. How many advisors do you have in your office?
There's three of us, myself included.
And so how many clients do each one of you have? Approximately.
Yeah, so we have 80 households at the firm. I think my business partner and I both have between 30 and 35 of those households where we serve as the lead advisor. And then we have another advisor that joined us 2 years ago, and she's working with about 5 clients as the lead advisor.
Okay. Why is this important to know how many clients you have?
I think it helps a client understand the level of service and availability of the advisor should a need arise. You know, if somebody's got 500 clients, they may be more difficult to get a hold of. They may be providing a diluted level of service relative to an advisor that has a much lower or lighter client load.
Yeah. I would say about 95% in the United States of people who call themselves advisors are basically driven on a commission base as to either whole or part of their compensation. And the average broker has approximately anywhere between 3,000 to 5,000 clients. And so it's amazing to me when you say that you break down to about 35 clients per advisor. What a contrast. I talk a little bit about when you have an initial client, what do you go through for that client?
Sure. Yeah. We like to request information that includes income tax returns, account statements, insurance policies, any legal estate planning related documents. So I think that's kind of the starting point for us. And then we're going to ask for more information around their objectives, right? Through meeting with them and talking to them, what's important to them, and what are they looking to accomplish with the assets that they have, and the assets that they will potentially be saving or drawing down on.
Yeah. So it takes a lot. It takes quite a bit of time.
It does. It does. And then there's, we have a service calendar that we use for clients to help us figure out the different tasks and activities that'll be necessary to, service that client throughout the year. And so there's a lot of work that happens behind the scenes, and we may be in touch with emails or phone calls, but there's truly ongoing work to support the clients.
Do you provide a free look-see or to review somebody's financial plan to see whether or not there's a fit?
Yes. Even if they're not a fit for my firm, it's one of my favorite things to do. I just see so many instances out there where there's small tweaks that can be made. If not, maybe much larger overhauls. But I think I really enjoy looking at that and helping clients figure out what they can do to better.
And there's no charge for that, or an obligation to come with you as far as a firm is concerned?
Correct.
Okay. Let's see what else. Do you receive any income from any other source besides your client?
No. No,
Why is that
100% of my
important?
firm's revenue comes from our clients, and that's critical because we don't have a conflict of interest. You know, if we were being paid by an insurance company or a mutual fund company, um, there's a conflict there, and that conflict does not exist in our model.
Yeah. And what's the difference between a Schwab, for example, and a Merrill Lynch and a Morgan Stanley, a UBS? What's the difference between those two different kinds of firms?
Well, there's a bunch of differences. Is there one in particular, Pete, that you want me to try to
Well, you pick
focus
any
on? You have in
major
mind?
brokerage house.
Okay.
Let's say Merrill Lynch. It's now owned by Bank of America. So
Yeah.
if I walk into a Bank of America branch and I talk to the Merrill Lynch agent, what's the difference between that agent and you?
Sure. Yeah, I think the biggest difference I think that we're looking at right here is that I'm not employed by Schwab, right? And so there's times I help clients with their accounts that are not at Schwab. If you walk into a Schwab branch, right, or you walk into Merrill Lynch, they're only going to really be focused on the accounts that they're working with there. We're completely separate from the custodian. I think all the other companies you mentioned, like UBS, Merrill Lynch, Morgan Stanley, the accounts are going to be held um, with the same company that's giving that advisor a paycheck.
Yeah. And usually you get recommended products that are produced by that particular company.
Correct.
So whether it's a Schwab account or a Merrill Lynch in that sense, although Schwab would be substantially lower price than a full service broker such as Merrill Lynch, UBS, or Morgan Stanley.
Yeah.
And please, if you work with somebody at a major brokerage house, you can look them up on FINRA as well. They have to publish every single person who gives financial information or advice. They have to be on registered with FINRA. So, and if you have a Series 7, Series 2, many of the other series licenses means that they're compensated on some sort of a commission basis. So please be careful. You're not associated with anyone who sells annuities, insurance, mutual funds, or other financial products. Is that correct?
That is correct.
Okay, and you certified the above as true and correct. And I just want to remind people that it only took about 10 minutes for him to complete this form that we just spent 20 minutes or more on. But please make sure you know this stuff about your advisor. Doesn't we're not trying to drive you to see Marty or any of our presenters. We're just trying to get you aware of what this industry is about. And following the money is probably one really good way to figure this out. And it's not easy, okay? It's there's to read a prospectus it is not easy. To learn how somebody is compensated is not easy. So let's go into the program, Marty, and let's talk about some of the changes and also some of the tax issues, because taxes are so relevant when we're coming to financial planning.
Okay. Well, good morning, everyone. This is, we're going to talk about a tax update right now. We just talked about me, so I'll skip over this.
On my screen, I still see your Ask First form.
Oh, okay. Thanks. Let me see here, Pete. Okay. Do you see tax update now?
Yep.
Okay. Great. Okay. So I'll skip over this slide. So
By the way, this entire outline is available to everyone online at IYME. So if you didn't download the outline. It's going to be available to you. And also this particular video will be available in about a week. Go ahead, Marty.
Thanks, Pete. So why is tax planning important? That's, a big part of what I'd like to talk about today. We're going to go through some of the tax law, but I think the angle that most of that will be addressed through is what can we do to take the knowledge we have of the tax law to use it for our own benefit. Because the less we pay in taxes, the more money we can devote towards other fun or financial goals. Working with the right advisor, and sometimes it can be a team of advisors, depending on the situation, can really help with making good decisions and minimizing taxes.
You mean you don't know everything?
No, and it changes too. So as soon as you start to begin to know more and more, then the law changes, and then you have to, which is part of the fun. But
yeah. But I think it's important for people to know that even somebody like Marty, who's in the industry for a number of years, has to work with other advisors on, depending on the topic and the situation. It's not easy, and it takes a team, but you got to figure out and recognize when you don't know something.
Yeah, and I think too, it's important to have that communication, because and I'll have some examples later on, but there's all sorts of examples where just giving a form, a 1099, for example, to a CPA to do a tax return isn't enough. All the information that is needed isn't necessarily contained on the form that's been generated. And if you don't provide additional context or information, that could cost money in taxes. And so I think it's really important to have that communication and have that team-based approach. Taxes, pretty broad topic. I mean, there's hundreds of taxes in our society today. I think there's really three that we're going to talk about today. It's the federal gift and estate tax. We're going to talk about property taxes in California, and then income taxes, which is where we'll spend most of the time. And we'll talk about some changes and planning considerations as well. Okay, so this is the federal gift and estate tax. I've got three numbers here. Okay, these are 2024 numbers. These amounts adjust with inflation over time. And for that first number, the annual gift tax exclusion, $18,000 is the maximum amount of money that one person can give to another person and not have to report it to the government.
Okay. Repeat that last three lines that you said, because people misunderstand that.
Yeah. You do not have to report a gift to another person to the government if you've given $18,000 or less in this year. Okay.
Yes.
And so if I'm married, which I am, and I wanted to give double that, I could give 18,000. My wife could give 18,000 to that same person. That person could receive $36,000. Now that person doesn't have to pay any taxes on that gift. I don't have to pay any taxes on the gift. I don't even need to tell anyone I made that gift. Okay. The second it goes to $18,001, right? Or if we went to $36,002 with my spouse, that would now be a reportable gift. I'm supposed to file a gift tax return and let the U.S. government know that I made a gift of more than that $18,000. Now, that doesn't mean that I have to pay taxes on it. It doesn't mean that the person that received the money has to pay taxes on it. But I have an obligation. The law is that I'm supposed to report that gift and let them know about it. Okay.
And then how does that work with the estate exemption?
The estate exemption, it is the maximum amount of money that one person can die with the value of assets, and pass on to their heirs and not pay estate taxes. Okay, so you can die with $13.61 million in 2024. If you're married, you can double that number, because that's per person, per spouse, and pass it on to your heirs. If you're over that, there's going to be estate taxes that come into play. Now, in addition to that being a tax at death, it can be used for gift taxes as well. You can give away $13.61 million this year in assets, and you have to file a gift tax return, but you're not going to pay taxes on it unless you've made prior gifts. That's the most amount you can give away in your lifetime right now.
By the
I
way,
think that's important. There's an overlap there between the gift and the estate tax or
Just-
exemption.
I just visited my son in Ireland, and I asked him what the estate exemption amount is in Ireland. Just to give you a comparison, it's 330,000. So you pay 33% on anything over 330,000. So this estate exemption at 13,610,000 is pretty nice. Is that going to be the same for the next 10 years?
No, unless there's a change in the law. But right now, the law is built so that in 2026, that number will get cut in half, approximately. We don't know because of some of the inflation adjustments, but I think it's safe to assume it's going to be between $6.5 and $7 million per person.
Yeah.
That's if there's no change in the law, which is always an unknown.
Yeah.
But
Yeah.
I think if you're, this is a problem that doesn't affect most of us, right? But it could, if you've got, $8 million today, right? This is not a problem that you have. But if you pass away in a couple of years and the law is unchanged, there could be an estate tax that's due. And so you have to start asking yourself whether you should consider giving away some of that money if you don't plan to use it. So it's a good problem.
It's a thing to be aware of.
Yes.
Okay, let's go to the next slide.
That last number, 40%, that's just the highest estate tax rate. So anything over and above the exemption amount is taxed at that rate.
Yeah. But by the way, for people who have these large estates, any type of planning with a financial advisor and with an estate planning attorney, you should be able to reduce your estate and gift tax to zero if you have the appropriate advisor. So it's almost a volunteer tax, and less than 1% of the population is going to be subject to this tax. So 99% of us, we're not going to have to worry about having to pay estate and gift tax. And the good news is, in California, by California Constitution, there is no inheritance tax.
Correct. Yeah, other states do have estate or inheritance taxes. The state of Washington, for example, New Jersey can have that. So there's different states out there that are quite different from the federal law. But thankfully, California, that's one tax we do not have. We've got
plenty of others.
Yeah.
Let's talk about property taxes.
Yeah. And so property taxes is a really critical issue here in California with the appreciation of real estate. For the property tax law enables someone to mitigate the increases on the property taxes. That is much more favorable than a lot of states where the property taxes can just go up with the market value of the home. And I think that, there was a law change a few years ago that was voted in, and the key takeaway that I wanted to point out from this slide is that if you're 55 and older, you can transfer your property tax base of your primary residence. So you're not necessarily stuck in a house, right? Sometimes we have come across that where clients feel like they're stuck in a house because the property tax base is so low, their property tax bill is so small, and they can't afford to sell that $2 million house and buy another $2 million house because the property taxes would go up and it would cost too much money. That's no longer the case. For a primary residence, they can transfer that low property tax base on a home of equal value. And there is still benefit if they wanted to go up in value. And I think there's the way that would work would be you'd still keep the property tax base on the same amount of value, but then you're going to have to pay market value property taxes on any increase in value of a home that you bought.
And I believe the old law was that you could only do that once, and it had to be in a county that allowed that to happen.
Yep.
So this is a real major change. I think it's been in effect a couple of years. I'm not 100% sure, but it is the law today.
Yeah, I think it went into effect in 22.
Yeah.
So it's been a couple of years. Sounds right, Pete. And it used to just be one time that you could do it. And I think there were 8 counties that participated. So sometimes, if somebody was in their 60s, they might say, well, I'd like to do it, but I don't want to use up my one time now. What if I want to do it again in 20 years or 15 years and I really need it more then? So I think to be able to do that 3 times alleviates that type of concern, and hopefully it helps somebody not feel stuck in their home.
Yes. Yeah. And a lot of times we like to buy down, and our home is getting too large for our age. But even moving into a smaller home, sometimes that tax base can be higher. So this is a real benefit.
Yeah.
Let's go to the next slide. This confuses everybody. For me, you need to know your tax bracket, just like you need to know what day you were born on. But to most individuals, this is so confusing. So let's go through it, Marty.
Yeah. The tax bracket's really based off the bottom number here, what's called taxable income. But this slide's intended to help you understand, how do we get to that taxable income number, right? How do we determine that? That's really the key number for determining how much taxes we're going to pay. And so you've got your gross income, right, which can be wages, Social Security income, IRA withdrawals, self-employment income. It could be a variety of different things that contribute to gross income. Less adjustments get you to your adjusted gross income. And that adjusted gross income is a number that other line items on the tax return will refer back to, right? So that's why we put that adjusted gross income number there in bold. We get from that adjusted gross income, we can take some deductions. The deduction is going to be based on either standard or itemized. You're going to take the higher of the two. Okay, and the standard deduction was increased in 2018. It was just about doubled. So we have far more clients now that are taking the standard deduction instead of itemized deductions. I think the couple of the key contributing factors too that have also led clients to be more inclined to take the standard deduction is that limitation on property and state taxes. Only $10,000 of that can be deducted as an itemized deduction now.
Is that going to be sunsetted as well?
That will be sunsetted, yes. So
when does that sunset come in? Is that also January 1st, 26?
Yes. Yep, January 1, 26. Yep. So that goes away. So if you're paying more than that in property taxes or income taxes in the state of California, your itemized deductions could very well increase in the 2026 tax return. But right now, it's limited to 10,000. And then interest rates were so low. Our clients' mortgage interest, the interest that they paid to the banks for their mortgage is really low as well. And so we're seeing a lot of clients that just aren't adding up enough itemized deductions to exceed the standard deduction up there. And you can see the amounts for 2024. A single taxpayer, Standard deduction 14,600. You double that if you're married filing joint.
So your itemized deductions have to exceed the standard deduction before you could take the itemized deduction. Do I have that
Well,
correct?
yeah, that's exactly why you would itemize. If all these expenses here amount to more than the standard, you don't have to do it. If you don't want to do the math, you could take the standard, right?
Uh-huh.
But a lot of us like to do the math and figure out if we're better off itemizing so we can reduce our tax bill.
So that's why the percentage of people who are now just taking the standard deduction is so high, because your itemized deductions just don't reach that limit.
That's correct, Pete. Yeah, and there's always exceptions, right? Sometimes we have elderly clients that are paying very heavy medical expenses, and maybe there are more.
I have a client, for example, that's in an assisted care facility, and she needs that, and we take it as all of her expenses, that's the assisted care facility, we take as a medical deduction. And so her adjusted gross income, or her taxable income, is very, very low. And so what we're doing, working with the CPA, is that we're withdrawing monies out of her IRA account because her income is so low, that with the offsetting deductions. So we're bringing in income from the IRA and not paying hardly any income taxes on that at all. How else would you say understanding your tax bracket helps you?
I think it.
You want to go to maybe the next page and take a look at the brackets? Yeah.
Yep. So yeah, this page shows you what your tax bracket is in the blue rectangle for ordinary income, and the green rectangle for capital gain income. Most income is ordinary income.
Annuity income is ordinary.
Correct.
Social Security is ordinary. Any kind of IRA income is ordinary. Do you have a list there of what's ordinary income? But talk a little bit more about why it's important to know your bracket that you're in.
Yeah, I think the most important reason to know the bracket is really to help you make decisions around what income can you control, right? Sometimes you just can't control it. You're just going to have the income and you're going to have to pay taxes on it. But other times, particularly when clients are retired and they're withdrawing money from accounts and living off savings, there's more control there. There's more decision making that can help them understand which account should they draw money from, which security should they sell in a given year based off of their tax bracket, because we can calculate how much taxes are going to be due before they actually trigger that income event. It also helps, I think, from a long-term strategy standpoint, to be able to understand what your tax bracket is today versus what you think it could be later on. Sometimes clients are retired in their 60s and they haven't received Social Security income yet. That Social Security income and minimum distributions from their IRAs in their 70s may increase their tax rate. And so there may be some things we want to do during their 60s to trigger income at these lower tax rates and take advantage of that.
Asset location, a regular IRA versus a Roth IRA. Is a perfect example of what you're just talking about, that you could start making some plans for. How about, let's say I'm a single individual and I have $20,000 of taxable income. And I do have a large IRA and I'm past 70. Should I be taking out the minimum required minimum distribution from my IRA, or should I be taking out more?
Most likely more. If you're at a really low tax rate, that could be the way to go. But we see that sometimes with Social Security income, it's more expensive than it actually than just looking at it's not as simple as just looking at the tax bracket. You know, you because of the way Social Security is taxed, you can actually pay more taxes than just the rate you see in the blue rectangle there, which
Yeah.
would be that 12% rate for a single.
Yeah. But what I see most people do is just to try to take out the minimum of their required minimum distributions. My point is that at some occasions, you want to may take out more than the required minimum. I don't
That's
think
correct.
yeah, I
Yep.
don't think taxes are going to go down in the future. What do you think?
Yeah, my opinion is that they also will not be going down.
Yeah, yeah. Another way that you need to understand your tax bracket is if you're going to invest in municipal bonds versus corporate bond. Talk a little bit about that.
Yeah, at the end of the day, you want to figure out what's going to allow you to keep the most amount of money, even if you have to pay taxes. But if you're getting a higher yield or a higher interest payment from a corporate bond, and your keep percentage is higher, then that can frequently be better than a municipal bond that is tax free but may pay a lower yield. But that depends on the tax rate and the tax bracket you're at. You know, our clients at the higher tax rates may be better off with municipal bonds, and they frequently are. If you're in the lower tax brackets, taxable bonds can give you a higher keep percentage there.
Yeah. The key is that if you're having to pay more taxes, that means you've earned more money. So I've heard people say, no, I don't want any more income because I have to pay taxes on that.
Yeah.
Well, taxes are a small part of it. You want the income. What's the difference between the ordinary and capital gains?
Yeah, I think capital gains really just applies to a narrow subset of income where it's a gain on the sale of assets over longer than a year. Or it can also, that rate also can apply to dividends on qualified stock. Beyond that, pretty much everything goes over to ordinary income.
Yeah, but what amazes me is that if you have capital gains income, you can earn close to $47,000 and pay zero tax. I don't understand that.
Yeah, the 0% tax rate on capital gains, it's 47,000 if you're single, 94,000 if you're married.
So when you
That's a
do,
huge planning opportunity.
yeah, so when you do investments for individuals, do you try to stay away from the ordinary income and try to get their income more into the capital gains area?
Yeah, we do. That's something that we're always cognizant of, but sometimes there's a risk reward trade-off there with investing, and that needs to be considered. So that's the balance and the overlap between investing and taxes.
Yeah. So everything is a balance. Talk a little bit about that net investment income tax. What do you mean by that?
Yeah, if your income exceeds 200,000 if you're single or 250,000 if you're married, there will be a 3.8% net investment income tax that applies to capital gains or investment income. So that's something that we see frequently if there's a large capital gain in a year, or
There's a sale of a house or a rental property, etc., or a large gain in a stock.
correct.
Yeah. Yeah. So people need to be aware of the tax consequence before they sell an asset. Would you assume that's should be the way to go?
Yes, definitely. You want to be able to set aside money to pay the tax bill, and you want to be able to ask yourself the question, what can I do to mitigate this, if anything?
Yeah.
Sometimes there's nothing that can be done, but sometimes you may have some different options. Clients don't always like the options, right?
Yeah.
But at least you're educated and
Yeah.
you understand what the options are, and you don't have to always um, you can always just pay the tax and move on, but sometimes clients are interested in.
Yeah. What I see most people do is become aware of the tax consequences the following year after the event. And is
Right.
that, is that too late to do anything?
Yeah.
Yeah.
It's generally too late there. Yeah. With few exceptions, it's going to be too late.
Yeah. Do trusts pay a different tax rate than individuals?
The rates are the same rates you see here in the blue rectangle, but what's different is the income. The top 37% bracket kicks in at about $13,000 or $14,000 of income.
So that's
the
for
brackets are really
irrevocable.
compressed for trusts.
Yeah, that's for an irrevocable trust.
Correct.
Yeah.
Any trust where it's paying taxes on its own return instead of issuing the income to a personal income tax return.
Yeah. Okay. Let's go to the next slide.
RMDs. So this is a relatively new update. So based on your year of birth, the age at which you must begin taking distributions from retirement accounts like IRAs, 401ks, is listed here in the column on the right under RMD age. Okay, so that's a quick slide.
And this is a biggie.
So to follow up on the required minimum distribution, in lieu of a required minimum distribution, you can direct money from an IRA to a charity. So it satisfies all or part of your required minimum distribution if you tell your custodian to send money to a charity instead of your own bank account. And you can do that with up to $105,000. So it's capped at that per year.
Well, let's go back a little bit before the QCD came into effect. What most people did 5 or 10 years ago was take money out of their IRA account and then took that money and part of that money and donated some of that to charity. And then whatever they gave to charity, they used that in their itemized deductions. Well, today, most of us use the standard deduction. And so we don't get credit for any kind of charitable donations from a tax point of view. Right. And so if you're 70 and a half and have an IRA account, is this the way to do it?
Absolutely.
And why is that?
Because if you take a required minimum distribution out, you're going to have to pay taxes on that income. But if you instead direct that money you would have taken as a required minimum distribution to a charity, there's zero. That money does not need to be reported as income on your income tax return. And
so, and the limit to $105,000 donation in any 1 year. But what's new as well, and we don't go into too much detail on this, but you could now take $50,000 out of your IRA and do a charitable gift annuity, and which is brand new. And a charitable gift annuity is completely different. Well, 90% different than a commercial annuity. So if you are thinking about you're up in 80 plus, you may, and you need additional income, and you're charitably minded, you may want to think of a charitable gift annuity as another way of taking money out of your IRA account. What happens now when you take your IRA account and you give it to your kid? Can they still take it over their lifetime?
No, they have to take. So a child that inherits an IRA needs to take that money out over a 10-year period.
Yeah. So that's a difference as well.
Yeah.
Lots of little nuances out of this stuff. So if you're not on top of it, need to get some advice.
And the charitable gift annuity, Pete, that's, I just want to make it clear that that's a great way to give, because the charity also will give you money back, right? That's what the annuity is. It's paying you back money every year over
Yeah.
your life. And
Yeah.
so you
And when
can
you
give
get
and receive there. And then
yeah.
that was inflation adjusted to $53,000 just this year. So it went up a little bit, and it will likely go up next year as well.
Yeah. And your rates on a 53, excuse me, on a 80-year-old, I think is close to 7.5%, somewhere along the line. And
Yep.
a lot of it will be tax-free from that as well.
Yep.
So but you got to run the numbers, okay? So sometimes these things, even if you're not philanthropic, they're good, they're financially good for you. Let's go to the next slide.
Yeah, there's a question that just came in. Is it only a child that gets the 10-year period to take out IRA inherited? Could it be a sibling or non-related person? So it's anybody but a spouse has to take it out over 10 years.
Yes, a spouse does not.
Spouse does not, but any non-spousal beneficiary has 10 years to take it out. So that's why there can be opportunities for planning across generations even there. We may want to look at, well, what tax rate do we think the next generation to inherit this IRA may be at? And how does that inform us with what maybe you should be doing today with your?
Yeah. Whether or not you should be transferred part of it to a Roth IRA versus keeping it in the regular IRA, whether or not to take out the more than required minimum. Do you review IRAs as far as part of the financial plan?
Absolutely.
Yeah. Well, talk a little bit about asset location. Why is that important as to how you manage that money?
Yeah. So asset location is the lingo that we use to refer to which investments are owned in which accounts. Okay. And we can generally own the same investments in any account. But the reason we may choose to own different investments in different accounts is because the income tax treatment associated with the accounts can be different, right? An IRA is only taxed when money's withdrawn from that account. During the course of a year, if we make trades in an IRA and there's money made and then money's kept inside the IRA, there's no taxes due on that. It's not until the withdrawal from the account that there's taxes. And that's completely different than let's say a taxable brokerage account, where if we sell one security at a gain, there's going to be a capital gain at 1099 that creates a taxable event. The third type of account that's out there, Roth IRAs, right? No taxes on trades inside that account throughout the year, and no taxes on withdrawals either. So the Roth IRAs tend to be a place where we're a little bit more aggressive because we know we don't have to share that money with the government. It's going to be 100% of family money.
Yeah.
Then the fourth type of account that I think is gaining some steam is HSAs, right? And so HSAs weren't around until maybe like 15 years ago, but they've been around long enough that clients are starting to accumulate assets in these.
What does HFA stand for?
HSA is a health savings account.
Okay.
And so you can only put money in if you have a high deductible health plan. So there's a lot of people that don't have them. But if you do, you're able to put money in, get a tax deduction for the money you put in, and then later pull it out to cover healthcare expenses. And so it's basically a tax-free account. One of the things that you can do if you are saving money in an HSA, you can save your receipts for healthcare expenses you've incurred over the years and not withdraw the money from the HSA until years later. And that allows that account to keep growing tax-free, and you can choose to reimburse yourself in a future year for a healthcare expense you had in a prior year if you do need to take money out. So
which is unheard of.
Yeah.
That it allows you to have a health expense 4 years ago and deduct it today. You know, also, if you're an entrepreneur or a business owner, can you set up your own separate retirement plan?
Yes, if you own a business, you can set up your own separate retirement plan. It's easiest if you are the only employee, right? If you're just self-employed, no employees, that's pretty easy to do. If you have employees, then you have to be a little bit more cognizant about how those retirement plans work.
There's a question is that if you have to take out a required minimum distribution, do you have to take it out of each account, or can you just take your required minimum distribution out of one of your accounts?
It depends on the account type. So if you have all your money in IRAs, you can just take it out of one. You have to do the math using all the IRAs. Okay, but if you've got 3 IRA accounts, you can just pick one and take it out of that one. But if you have what's called qualified retirement accounts, such as 401ks, 403bs, those may need to be treated separately, and you may need to take those out of different accounts. So it depends on the account type, and it can get a little nuanced, and it's important to understand that. I think while we're on this slide still too, for qualified charitable distributions, if you have a 401k and you're no longer employed and contributing, that may be a reason to consider rolling over a 401k to an IRA. You cannot make a qualified charitable distribution from a 401k.
Yeah, a lot of people keep their 401ks, and if the 401ks are driven by the employer, and they're not that beneficial to the employee if you're no longer employed there. So really look at the rollover situation, and as you get older, keep it simple, stupid. You know, don't have 10 different accounts. Try to see if you can make it much simpler, because it allows you to stay in control of your money, and you'll be happier and you'll understand it better. Any comments on that, Marty?
No, I generally agree that the fewer accounts, the better, unless there's a benefit to having an additional account.
Yeah. And
sometimes there's different
yeah.
situations it can make sense, but if there's not a benefit, generally consolidating and simplifying is going to make life easier.
It's one of the problems with these workshops, or any workshop that you go to and you hear information, you know, you don't know for sure how it applies to you. And it's kind of like, for most of us, a commercial annuity is not probably that advantageous. At the same time, if you bought a commercial annuity 10, 15, 20 years ago, it might be paying you more monies than you could probably maybe earn somewhere else. So before you make a change, please understand what you're paying today, what the change is going to cost you in taxes and fees, and then what is it going to cost you after you make the change? Because there's always going to be a cost somewhere involved, either in taxes or in fees. So we like to consider ourselves the unchanged workshop, because you want to understand your entire financial situation before you make that change. Let's go to your next slide. We only have about 4 minutes left.
Okay.
Yeah, the question is, do we need to ask financial organization to take MD when we turn 70 and a half? Required minimum distribution, I believe he's asking for.
Yeah, so I would take a look at your birth year here, right? And if you were born before July 1, 1949, 70 and a half is the age. If it's a different, date of birth, you can look at this chart.
Yeah.
But yeah, you would want to contact them. Some organizations will do it automatically. But I think it's best to contact them Sometimes we see issues with the automatic, particularly if you have multiple accounts and account types. It's nice to have some sort of strategy there on the distribution. But yeah, you can contact them and have that provided.
Okay. Well, we have one other question, and that is, I'm going to do it generally. Do hospitals charge less if you give them a donation? And the answer to that is no, they don't. Usually the foundation and the hospital organization as a whole run separately. And what I can tell you is that if you become a donor of a hospital, they are going to treat you probably a little better than a non-donor. But at the same time, it's pretty equal. They want you to get better. So no, the answer is no. Donations do not reduce your hospital bill. Next question. I mean, let's go to your last slide.
Okay, this will take like a minute. So this is just the income related monthly adjustment amounts that apply to Medicare Part B and Part D. Okay, so based off these columns on the left, income thresholds, right? You get the first columns for single, second columns for married filing joint. You can see additional premiums charged for Medicare. Now it runs 2 years in arrears. Okay, so your 2024 premiums are going to be based off your 2022 income thresholds. You can see that right there. That's a part of tax planning, right? It doesn't always come up, but it's certainly something to consider because it is an additional tax. You're paying more based off your income for the same healthcare.
Okay. Hey, we did it. Let's go ahead. By the way, if somebody has a particular question, they want to do it privately, can they give you a call or send you an email and to you, and can you respond to them?
Yes, I would be happy to.
Okay, great. Let's put ourselves online, and if anyone has a question, please feel free to ask. Wait a couple of minutes. Is there anything that we didn't ask you, Marty, that you think might be important as we start our journey into these workshops for the next 5 weeks? Any comments that you would like to make?
Don't be afraid to ask questions. I think it's really helpful, hopefully not only for yourself, but for the other participants too, because a lot of times as presenters, it helps us recognize what we need to better clarify or focus on. And I think it's just helpful to get that input from the attendees. So, I mean, I think that's, goes with anything, not necessarily specific to these workshops.
Okay.
But then if you do have a question that is very specific to your situation, or maybe you're just not comfortable sharing, in front of
share your email again. Somebody just asked for your email address. By the way, it is going to be posted online. So at IYME, and there's Marty at merrickwealth.com. So take a look at that. Next week, what we're going to be doing is going into Financial Planning 1, and kind of what Marty was talking about when he first meets with you and you engage him. What is that first meeting like? What does the financial advisor need? And that's what we'll be talking about next week. If you are signed up for tomorrow, tomorrow is our estate planning session from 10 to 11:30. But please, you will need to register for that separately. Marty, thank you so much. Really appreciate it. Eugene, thank you for doing the technical background. I think we did it for your first time. I think it was successful, and we'll see everybody real soon. So we'll sign off right now, and thank you for attending. Take care.
Yes. Thank you, everyone.
Right, thank you.
Bye-bye.